So hi guys, welcome back. Today we're going to be looking at Churchill Capital and their reported acquisition with Lucid Motors, which is coming in the near future. So today we'll be looking at the new acquisition and we're going to be looking at the pros and the cons of investing in CCIV, which is the ticker symbol of Churchill Capital. If you do enjoy, consider subscribing. It is free and it does help me out a ton. If not, thanks for watching anyway. Onto the video. So just to note, CCIV or Churchill Capital is a SPAC. So what exactly is a SPAC? A SPAC is a special purpose acquisition company which acts like a blank check or a shell corporation, and it's designed to take a company public without going through the traditional IPO process or initial public offering process. It's a shell company which is set up by investors with the sole purpose to raise enough money through an IPO of CCIV and eventually buy out another company, in this case Lucid Motors. So SPACs can be used to buy anything from financial services to tech startups to firms. However, most of the recent SPACs and CCIV in particular have come out in investing in the electrical vehicle industry. This is because it's a very profitable and has good sentiment from many investors, making it a good investment for CCIV. So it has recently been reported that the electrical vehicle maker Lucid Motors will be acquired by CCIV in a recent report, and Lucid Motors targets the luxury end of the auto market, basically like Tesla cars but higher end, and CCIV has raised more than $1.8 billion as of right now. So the stock is currently trading at $56, and this is the result of pure speculation because we had a new report that CCIV and Lucid Motors will be having acquisition. CCIV stock is up more than 400% over the past 3 months, clearly outpacing the S&P 500 and Dow Jones. We'll be looking at why this is a pro and a con later on when we look at the valuation of this company. But as of right now, more people believe that the deal is happening rather than not. Sources say that CCIV is looking to attract more than $1 billion by selling shares in private investment in public equity, so PIPE transactions, for the Lucid deal. And if everything goes according to plan, Lucid Motors will get a $12 billion valuation. So with Lucid Motors having a $12 billion valuation and Churchill bringing $2 billion to the deal at the valuation, Churchill investors will own 16.7% of Lucid. So with Churchill's market cap about $15.8 billion, that means that the market cap, not the valuation, the market cap of Lucid will be close to $95 billion. So it can be considered expensive for many investors. So just a little bit about Lucid's growth potential. It was founded in 2007 and is based in Newark, California. The company is one of the more promising electric vehicle startups out there. And its first all-electric offering, Lucid Air, was unveiled last year. They've been selling the Lucid Air about $77,400, with tax credits going up to $7,500. So if you consider that, the base price of the Lucid Air is $69,900, which is a pretty good number when you think of the company's biggest competitor would be the Tesla Model X. So the Lucid Air is just the Tesla Model S but higher end. So it's not too expensive of a price for new car buyers coming into the market. Many investors believe that it will be a good trend and will be able to outpace Tesla in the near future, while others have a lower sentiment saying that Tesla can easily outsell this company. But we do need to understand that looking at the current market, you see Ford, you see Honda, you see Nissan, you see Kia, see all of these very prominent car brands all being quite successful in their own realm. So we have to stop going down the narrow mind saying that Tesla is the only electric vehicle company out there. And we do need to understand that there is possible for other companies to come in and disrupt the market. So that's why I believe that Lucid has a good growth potential. The last thing we'll be going through is the cons of investing in CCIV. Because Lucid will have a market cap of $95 billion, this can be considered extraordinarily expensive for especially an unprofitable company, let alone a company who only started selling their first cars last year. On top of that, the stock price of CCIV has gone up more than 413% over the past few weeks, making it quite an expensive buy. And if you do choose to invest and the deal gets broken off, you will be losing a lot of money. And that brings me to my last point, is that There is a lot of speculation into this deal, while sources have said that it is quite possible that there is a high chance that this will go through. We do need to understand that the deal is not 100% confirmed, so there is always an additional risk that it will not go through. So if you do choose to invest in CCIV, make sure to do your own due diligence, and thanks for watching. Bye.